So let's talk about 2026, because there's really one big question on every single investor's mind. After an absolutely incredible multi-year run, is the tech trade finally dead? Today, we're going to dig into what the big institutional money is saying and where they're looking next. Let's get right into it.
After the absolute tear that tech has been on from 2023 all the way through 2025, it is the elephant in the room. And this isn't some small talk question. This is what major financial institutions are pouring huge resources into figuring out right now. Is the party finally over for big tech?
And just take a look at this chart. It really shows you how dominant tech has been, just crushing the rest of the market for 3 years straight. We're not talking about a small lead here. This was a total takeover. And that is exactly why a potential shift in leadership, what the pros call sector rotation, would be a massive deal for, well, pretty much everyone's portfolio.
Okay, so if we want to figure out where the smart money might be headed, we've got to start with the big picture they're all looking at, the economic forecast for 2026. First up, let's talk about the R word, recession. JP Morgan is putting the odds of a global recession in 2026 at about 35%. Now, that's not their base case. It's not what they think is most likely to happen, but a 1 in 3 chance is definitely high enough to get the big players thinking, maybe it's time to play a little defense and find some safer places for our cash.
The other huge piece of this puzzle is interest rates. JP Morgan is expecting the Federal Reserve to cut rates by another 50 basis points. That's just Wall Street speak for 0.5%. And this is a massive catalyst because, when it gets cheaper to borrow money, it basically flips the whole investment landscape on its head, and it makes some sectors look way more attractive than others.
So when you put it all together, the big picture for 2026 looks something like this: slower growth, inflation that's still kind of stubbornly sticky, and what the experts are calling a reflationary environment. In simple terms, it pretty much just means that governments and central banks are pumping the gas to get the economy moving again. And that has huge implications for where the money flows next.
Which brings us to this key idea, sector rotation. If you're new to the term, just think of it like a giant game of chess. Big investors are moving their money, their pieces, out of sectors that have already had a great run and into the sectors they think are about to take off next. And based on that 2026 forecast we just talked about, it looks like the whole board is being reset.
So, where is all this money actually going? Let's dive in and see which sectors are getting tipped as the potential new market leaders for 2026.
All right, so the first major theme here is really interesting. It's not about abandoning AI. Not at all. It's actually about realizing the AI boom is getting way, way bigger. As JP Morgan's strategy chief points out here, this isn't just about the usual tech suspects anymore. The AI supercycle is now spreading out and lifting up the entire economy.
And just look at the sheer scale of the money pouring in. This chart shows CapEx, which is just a fancy word for what big companies spend on major projects. And the hyperscalers, the giants like Google, Amazon, and Microsoft, they're on track to spend over $500 billion by 2026. That is an absolute tidal wave of cash, and it's creating this huge ripple effect.
So who gets a piece of that $500 billion pie? Well, according to JP Morgan, it's what they're calling the AI-adjacent sectors. And it makes perfect sense when you think about it. All those new data centers need a mind-boggling amount of power, so utilities are in play. The banks are financing this historic build-out. Healthcare is using AI to discover new drugs. And of course, the industrials and materials companies, they're the ones literally building all the physical infrastructure. So you see, it's a much, much broader game now.
Okay, the second big theme we're seeing is a shift in geography. For years, it felt like the US market was the only game in town, right? Well, big money is starting to look for better deals overseas because, frankly, US stocks have gotten pretty expensive.
And you can see that exact thinking right here. LGT Wealth Management, for example, is feeling pretty neutral on the US, pointing to those high prices and the fact that just a handful of giant companies are driving everything. Instead, they're really favoring Japan and Europe. You might ask why. Well, it comes down to better valuations and some really interesting corporate reforms, like what's happening in Japan with Sononomics, which is all about pushing companies to treat their shareholders better. And that could unlock a ton of hidden value.
But hey, no strategy is ever a sure thing. So let's flip the coin and look at the big risks that could totally derail this whole outlook.
I think this quote from a JP Morgan strategist really sets the tone perfectly. Fragile is the key word. You've got these tailwinds pushing some areas forward, but at the same time, there are some pretty serious headwinds we have to keep an eye on. Okay, so let's break down the main areas that have people worried. First, those huge tech stocks we've been talking about. Valuations are through the roof, which means expectations are sky high, and any little disappointment could be really painful. LGRT is also cautious on high-yield credit. Think of those as riskier company bonds, because they can get hit hard if the economy slows down. And JP Morgan points out that even supposedly safe U.S. government bonds could be vulnerable if interest rates were to start creeping back up again.
All right, so we've looked at the economy, the potential new winners, and the big risks. Now let's circle all the way back to that very first question. What's the final verdict on tech?
So after all that, is the tech trade really, truly over? Well, the consensus from the big institutions seems to be a pretty clear no. But, and this is a huge but,
The experts are calling it a structural transition. So tech isn't dead, it's not a dot-com bubble burst part 2, but its time as the only game in town, the sole leader of the market, that's probably over. Instead, leadership is spreading out, broadening to all those other sectors we just talked about, many of them getting their own boost from that very same AI revolution.
Okay, let's boil this all down into a quick TLDR summary. If you're building out your watch list for 2026, these are the key takeaways from what the big firms are saying.
Here's the bottom line. The big bet for 2026 is on a market with slower growth, stubborn inflation, and those all-important rate cuts from the Fed. The money seems to be rotating into those AI-adjacent sectors like utilities and industrials, and it's also looking overseas to places like Japan and Europe. It's rotating out of, or at least trimming back, the most expensive, crowded tech stocks and riskier credit. And the one huge wildcard? If inflation stays too hot and the Fed can't cut rates, this entire playbook could get thrown right out the window.
And of course, as always, please remember this is all for educational purposes and is not financial advice. The really big question now is, will this rotation play out like the experts think, or does the market have another big surprise waiting for us in 2026? Let me know what you think in the comments below. Thanks for watching.